Well, welcome to the Debt Matters podcast, where we help Canadians find solutions to their debt with licensed insolvency trustees from across Canada. I'm Wayne Kay, and in today's show, we're going to talk about whether you should refinance your home to avoid debt problems or consider home equity, line of credit, or what is the best thing for you to go about doing. My guest today is Derek Chase from Derek Chase and Associates in Campbell River, British Columbia. Derek, great to have you on again.
Thanks very much, Wayne. It's a pleasure to be here.
Well, Derek, just before we started recording, we were actually talking about how you've been in the industry for quite a while. And this show is all about helping Canadians that are in debt. And I'm sure you've seen just about every possibility of how people get into debt problems.
It's true. There's a million different reasons that a person can get into financial difficulty. The federal government does try and keep a handle on some of the trends and ways that people can get into trouble, but there is no shortage of different possible twists and turns where people can find debt problems and financial hiccups. So it's really good for this podcast to get some of the facts out there and some of the different nuances and options that the public can look to for help.
Yeah, and I think what's really great is that emotionally it helps so many people, because when you get into these situations where you don't know how to get out of it, it's just you're dug into this deep hole of debt, and it can be terrifying. You're losing sleep. You're probably getting phone calls from bill collectors. The stress alone, I can't even imagine what people go through.
Yeah, again, very much true. I was just talking to a lady yesterday who was visibly shaken by her financial situation, losing sleep, very shaky. And as we progressed through the meeting and just provided her with a lot of information, you could see that stress and anxiety just slip away. And she was able to leave with a solid plan for the future. And I think she would have slept a lot better that night.
Oh, I can just imagine. So that's really, as you mentioned, this is what the show is about. It's about helping, real people that are in these situations. And really, it's a lot of times it's no fault of their own. You never know what's going to happen. And all of a sudden, I don't even know what the stats are, but it's a very high percentage of Canadians that are like one paycheck away from having major financial problems.
That's true. I don't know those specific stats myself, but you see that in different media sources from time to time, where a fairly significant percentage of people are just that one interruption of income away from having true debt problems. So it's definitely good to get more information sooner rather than later.
Yeah. Terrific. Well, why don't we dive into today's topic? We're talking about, people that are in a bad debt situation, and maybe they have their home and they're probably wondering, we've had this question, should you refinance your home to avoid debt problems?
Well, certainly with the rise in real estate prices over the last several years, that is more of an option than it used to be. I can remember times where it just was impossible to go to your home for refinancing because the equity or the value wasn't there. But currently, there's a tremendous amount of value in people's homes, so it's natural to look at that as a possible source to deal with your unsecured debt. And there's a variety of different ways that you can access equity in your home. And it's a bit of a journey to explore all of them to determine which one is right and which one is not going to fit or just simply be too expensive to do.
Mm-hmm. I would imagine there's a lot of, it's not one solution doesn't meet everybody's needs.
100%. Yeah, you definitely need to look at each of the different options for refinancing in order to see which solution would be helpful for your own particular circumstances. I think the first place to go whenever you're looking at getting some help with equity coming out of your home to deal with your unsecured debt is to look at where your mortgage is now. If it's with one of the chartered banks and perhaps your term is coming near for renewal, simply have the discussion as to whether they would advance more money than they currently have. I think that's definitely the first step.
Okay, so contact your bank, and even if it's not a traditional bank, I'm assuming there's numbers they would call to find out. And you mentioned if you're coming up for renewal, is refinancing an option?
I think so. And it's definitely worth the conversation. And a lot of people also lately have used mortgage brokers to help with that potential shopping for the renewal or remortgage. And it's worth looking at just because of the numbers these days allow for that potentially extra pull out of your house equity when your mortgage does come up for renewal.
Mm-hmm. Yeah, a lot of people have made a fair amount of money with their real estate, especially in the last 18 months, 1 year even. We've seen a lot of growth when it comes to real estate. So there may be enough in that to maybe leave them with a down payment. I'm sure the bank would rather just renegotiate some kind of a deal with them. It's my assumption, but I'm no banker.
Yeah, it's definitely possible. And that's why I say there's a variety of different routes that a person could go. Another one that comes to mind is putting a second mortgage on your property. Second mortgages get to be a bit more tricky because typically you're looking at a Class B lender or a second tier lender, and the interest rates start to get higher. And that's where I think people need to really be cautious in that setting, because in addition to higher interest rates, some of those lenders also whack on a really high administration fee to pull out more money. And the combination of those two things makes it a very expensive way to pull money out of your house.
Yikes. Okay, that's a great warning. Is there like a flat fee for refinancing, or like do you even worry about the fees?
If it's with your first primary mortgage, I don't think there's any additional fees, but when you go into that second tier of lenders, there can often be administrative fees that are substantial. So definitely you want to watch for that. And if the interest rate gets too high, again, it's something that you might not want to go ahead with.
On one of the podcasts, I was actually surprised to hear how high some of these other lenders can go when it comes to little mini loans, if you will. I was really shocked. So is there a safe like 5%, say under 5%, or I don't even know what mortgage right now is, what, 2.5%?
There can be a tremendous variability in those interest rates, and the lender is always going to look at the risk involved and what type of property it is. So there's a lot that goes into that particular interest rate that you might get, particularly if it's for a second mortgage. Another way that has become popular to pull money out of your house is through a home equity line of credit, which is a product that the banks are offering, which is a line of credit that is secured against your home. And that can be useful because it can be just there and available for you, and you pull on it like you would on a line of credit, but it is secured by your home. So that's another product that a person can explore. And that often, would have a more modest interest rate, I think, than potentially a second mortgage.
Yeah. Is this a good idea? Maybe going in for the home equity line of credit? I would think the interest rates are always better. I remember we were looking at doing some renovating, and they said, definitely use the home line of credit, as opposed to like if you didn't have debt and you had a line of credit. If you didn't have a mortgage and you went for a line of credit, it's much higher.
I think you could debate both sides of that question as to whether a home equity line of credit is good or bad. And I think it comes down to whether or not you have the discipline not to just use it and kind of for anything and run it up, because there is the risk that if interest rates rise or your property actually goes down in value, there can be some complications there. So just like with any financial matter, if you've got the discipline to be careful about it, then I think a home equity line of credit can be great. We have seen some causes for financial difficulty, for example, like we touched on earlier, where one spouse, unbeknownst to the other spouse, starts spending on some area that is just not good. It could be a gambling situation or something else. And that home equity line of credit could be tapped into very easily to do that. But everyone that's involved with the home ownership is on the same page and disciplined about it. It can be an excellent way to utilize the equity in your home.
So as an LIT, somebody comes into your office and says, okay, I've got this much debt. You obviously ask, okay, do you own your home? How do you look at how an LIT helps solve the debt problem for homeowners?
It has become a little more complicated with the rise up in real estate values, because creditors or unsecured creditors have the right to get paid if a person has an abundance of assets. Where we see some homeowners get into problems is that although they do have significant equity in their house, they still can't seem to qualify for even high interest second mortgage, or they want to keep their house. They like it, that there's no other place they can really go to, so they don't want to sell it to pay off their debts, but they can't qualify to refinance or to put more financing on it. So in those circumstances, what we've been able to do is utilize a consumer proposal to make a proposal to their unsecured creditors for sometimes a full payout over time, but it just allows them to keep their house and control their debt, their unsecured debt, by consolidating it into that consumer proposal process.
Can you explain, if somebody has just heard the term consumer proposal for the first time, what is it?
A good question. A consumer proposal is a Government of Canada federally approved program where you can make a proposal or offer to your unsecured creditors for a certain payback over time in full settlement of the debt. And it's become a very popular way to consolidate debt across Canada, and is very, very useful. The creditors seem to like it. People seem to like it because it boils down to one payment that fits your monthly budget with either zero interest or very modest interest if you have lots of equity in your house. Over the last couple of years, it's actually outpaced the amount of bankruptcy filings across Canada. So that's an indication of how popular it's become.
Wow. That's good for people to know that there is an option. I would imagine you've seen a lot of people who are in that situation we were talking about earlier on, where they can't sleep. They know the debt's getting worse. It's growing. They don't know where to turn. And so then they start thinking, well, I guess we better just sell the house. And then, of course, what do you do? Because rentals these days are almost impossible to find in many cities across Canada. And to buy another one, same thing. How are you going to do that? How are you going to refinance? All those kinds of options. So good to know that there are different ideas. And when it comes to dealing with a licensed insolvency trustee, we know that people are listening to the show. They understand you're governed by the government, right?
We are regulated. We're firstly licensed by the federal government as a trustee. So we're licensed insolvency trustee is the only one that can actually file a consumer proposal on your behalf. So firstly, you're licensed. And then secondly, we're also regulated through the federal law. So the federal government monitors what we do. They come in and visit our office. They audit our trust bank accounts. It's a good oversight procedure for the protection of the public. And it's one area of government, I like to say, that does a pretty darn good job in what they do.
Right. Yeah, that's good. And when you were talking about a consumer proposal, let's just use some numbers for an example here. So if somebody is, to make math easy, $100,000 in debt, when you go to do a proposal like that, do they end up repaying the entire $100,000, or can you renegotiate where they only end up paying, $25,000? Is that under the same umbrella as a consumer proposal?
That's an example of a consumer proposal where someone might offer $25,000 paid over as long as 60 months to eliminate that $100,000. Now that's more applicable if a person didn't have a house with any large amount of equity in it, and that I think is the majority of situations that we deal with. It gets more complicated if there was large amount of equity in their home. Then they wouldn't be able to offer $25,000 on $100,000. It's just not logical. The unsecured creditors would say no to that, and the person would have to increase their offer because of their home equity in their home.
So every situation is different. Every situation needs to be looked at. And let's give you the final word. What's your final word of advice regarding this topic?
I think the first step is to check with where your mortgage is right now and see if you can renew and increase without any penalties or problems. And if that's not the case, then you might want to talk to a licensed insolvency trustee just to see if there's a smoother way to deal with your unsecured debt, which allows you to stay in your home.
And we should mention Derek and his team, they do a free consultation for the first consultation. So you can contact him through bankruptcytrusteebc.ca. Derek, thank you very much for all the information today.
You're welcome. It was my pleasure.
Well, thanks again, Derek Chase. And that's it for today's Debt Matters podcast. Make sure you subscribe wherever you get your favorite podcasts from. And of course, for more information, you can always check out debtmatters.ca. Thanks for listening.